Carmine, I dread to think how many Zoom calls you have had with CEOs, CFOs, business leaders that are your clients across the 150 countries you're currently based. What are they telling you? What are you getting a read of in terms of this economic lack of recovery?
Yeah, thanks, Caroline. There is no doubt. We've been talking about this for a while in terms of a seesaw recovery. And that's exactly what we're seeing. We are recovering, but we're recovering very unevenly, whether that's geographically, sector-wise. And so there are some sectors that are doing incredibly well. There's some sectors that are starting to rebound. And there's some sectors who really haven't done much at all, including hospitality and airlines and so forth. Everything to do with the internet, everything to do with technology is doing phenomenally well and will continue to do phenomenally well in a new normal. Even when we come to regionally, China last quarter announced 4.9% growth. The IMF, reduced their shrinkage from 5% to 4.4% for the U.S., for example. So there is recovery going on, but it's slow and it's very uneven, and it's very much either regionally based or sector based as we move forward. So that is what I'm hearing from our clients. But I will tell you, one thing is all our clients around the world, they are ready to move on. They are ready to move on from the pandemic. Yeah. They're investing, and so I do think there will be a lot of pent-up demand once people feel safe.
So, Carmine, when we talk about moving on here, I mean, there is this general sense that whatever we move on to as an economy, as a society, it's going to look a lot different than maybe what it was a year ago, and definitely maybe 4 years ago. You've had a trade war, you had COVID, you've had Brexit, you have all these sort of changes going on across the globe. I would think that how companies have to structure themselves and operate is just going to be a lot different.
No doubt, man. There will be a lot of change. Let's start with supply chains. We do a lot of work at EY helping our clients in terms of supply chains, and we've done a survey with our clients around supply chains. So first of all, only 20% of our clients and supply chains overall globally have been digitized. And obviously those 20% have been in a much better place during the pandemic than the other 80%. So that's something that all companies are looking to see how quickly can they get their supply chains digitized. And then there's de-risking their supply chain from a geographical perspective. That started even before the pandemic. That will continue and has continued. And its supply chains today are incredibly strategic because of what people have seen from the pandemic, from trade situations, and therefore there are more and more people focused on it as we go along. There are more and more clients focused on it. So supply chains are a big conversation. When we talk about trade, that's incredibly important. And I do want to say, as much as there's so many barriers around trade, the pandemic being one of them, relationships being a second, from what we see, companies still want to be global. Even startup companies, their marketplace is global from the very beginning. And so I tell our people and our leaders around the world that we have to act above the political tensions and so forth that we see around the world to serve our clients in what will still be a global environment, even though there will be tension.
And you offer us a glimpse of positivity, namely in some of the notes when you mentioned new business applications have surged between May and September. So we talk a lot about business closures, but there's tons of people out there trying to start up new businesses. What are those businesses? Are they small businesses, given, of course, that's a lot of the businesses that have shuttered during this time?
That's a great question. And there are more business applications. The percentage up from 2019 is 12%. And so what we're seeing is there are a lot more startups and continue to be startups in technology. There are a few that have been announced recently. And so anything to do with technology, with a way to work, a way to live in this kind of environment, there are businesses starting on that. Unfortunately, there are not traditional businesses in hospitality and so forth. There aren't many from that. And there are also financial businesses that are starting up. I mean, things like SPACs and so forth. So there's a lot of innovation going on in certain sectors. In other sectors, not as much. Those are the sectors that have really been hurt by the pandemic.
It's interesting that 2020 seems to be the year that we'd all been worried about E in ESG. Now, finally, 2020 is the year that people focus on the S, the social side of things, because this isn't just a health crisis, this is an economic crisis, this is a social crisis. We talk about stories in the news. I'm thinking of people wondering whether they should really be investing in Apollo management anymore, for example, because of ethical ways in which the business is run. What are you thinking about in terms of the way that businesses are governed at the moment? How are you looking at monitoring? How are companies looking to monitor themselves, measure themselves in terms of living up to some of these new focuses for investors and for stakeholders?
Well, thanks. What is absolutely coming out of the pandemic, there are two themes that are coming out that will continue and will be strengthened through the pandemic. One's around sustainability, and one's around social inequity and economic inequity. And those will continue, and that feeds right into ESG. We've been doing a project, EY's been doing a project with the other big four and with the International Business Council, which is led by Brian Moynihan, the CEO of Bank of America, and the World Economic Forum. And we've actually developed 21 metrics, and we've worked with all the members of the International Business Council, over 120 of the largest firms around the world, to distill. There are a lot of different frameworks out there on ESG metrics. We distilled them all into 21 metrics that are much more simple. And we're actually, in a meeting in January, we're going to have many of the IBC members sign up to disclosing these metrics. Metrics are a way to measure, but I do think it's incredibly important that companies are looking at their strategy and making sure that their strategy is based on stakeholder value, not shareholder value only. It's both profit and purpose, or purpose and profit, and to make sure that what's incorporated in their strategy is how are they dealing with all their stakeholders, including clients, their people, and society in general. So I think you're going to see more of this. You're certainly going to see more around the E, and you're going to also see more around the S. And the U.S. election will have a bearing on this as well, because actually whoever gets elected, I do think the U.S., which has been behind in particular on sustainability, is really catching up quickly, because investors are demanding it. Asset managers, asset owners are demanding it. We've had a lot of conversations, not only with our clients and with management, we've had a lot of conversation with board members. We've been on several Zoom calls to have a chuckle here, but on several Zoom calls with thousands of board of directors from around the world, really educating them on ESG metrics, because a lot of board of directors, when they were in management, they really didn't deal with this as much. And now, as board of directors, they want to know more. They want to make sure that they're holding accountable their CEOs in terms of what they're doing around ESG. So there's a lot more to come here. This is a major item that I'm focused on personally, that we're focused on at EY, and it's something that I think will be helpful to everyone.
It's a focus there, and we've heard this from a lot of money managers, that it's their focus as well. But of course, in order to sort of have an ESG approach, there also has to be an auditing approach, I guess, that embraces that. And I have to ask you about the Wirecard situation and about some of the scrutiny that it brought on the auditing process and the responsibility of auditors to identify fraud and to telegraph that fraud if found to investors out there.
Yeah, no, that's a fair question. I wouldn't be on here if I wasn't expecting that question. So on Wirecard, it's just a very unfortunate situation. People have lost a lot of money, and it's one that really has shown what a collusive fraud with many individuals involved in the fraud, what that can do. Auditing is based about financial auditing. It has standards that are global standards, and the standards are not really set and meant to catch a collusive fraud. That's something that would be much more of a forensic audit approach, and obviously would be a lot more intrusive and a lot more expensive. With all that being said, though, there is a lot of conversation amongst the standard setters around auditors and audit standards requiring to do a lot more around fraud. So the FRC in the UK 2 days ago announced that they're going to look at this, and they are going to expect the audit firms and the audit profession to do more around fraud. We also said that we will do some more around fraud, but every jurisdiction's a little bit different. In the US, for example, there's Sarbanes-Oxley. There are some things that the US has put in place years ago that have helped mitigate fraud, where in other jurisdictions, that's not the case. So there's more to be done there. And in a down economy, you're going to see fraud out there. And it's something that I think you're going to expect more of those until the economy really recovers.